Hello, I'm Shaun Richards of Notayesmaneconomics, and today I'm going to talk to you about inflation. Let's start with a bit of an international perspective, as it does provide some food for thought, which is if we look at Japan, the land of the rising sun, from the Bank of Japan meeting overnight, the news coming out from Governor Kuroda is that they're on their way to achieving a 2% inflation target. Except they've been on their way to that now for 5 years. In fact, you could argue for the period of the lost decade, so 20 odd years or so. Where this gives us something to think about is we look at the UK, over that period, we're in the same world, many of the same influences, but we have no trouble at all in achieving our 2% inflation target. In fact, we're quite regularly above it. That is often the norm here. So that gives us a clue into the fact that we are what I call an inflation nation. We're prone to it. Why does that matter? Well, it matters particularly in the credit crunch era because so many things revolve around real wages. This has become the crux number, looking at how people are individually trying to go forwards. What will that have impact on the economy? What we find is, though, here, real wages are finding it hard to go anywhere, because inflation is round about that sort of number. What I mean is if we take away the various things we've had, the decimal points, we've had wage growth of between 2 and 3%, but we've got inflation of between 2 and 3%. So it's not really taking us anywhere. And that is a current conundrum. Thrown into the mix this morning was a couple of factors that actually saw UK inflation pick up. So if we go back to what was the official measure called CPI, that went up to 2.7%. Again, back to the wages issue, that compares to the last number we got for total pay of 2.6%. So if you want to be really accurate, real wages are falling by 0.1%. In reality, the numbers aren't that accurate, but they're going nowhere, on a road to nowhere. The pickup was partly due to package holidays, oddly. This year they were a bit more expensive, and something that's a much more consistent player in this game, which is transport costs, price of fuel. I looked up yesterday the latest official numbers for petrol and diesel prices at the pump, and over the past year they've gone up by about 11 pence for petrol, 14 pence for diesel. So that's a factor driving these numbers. Something else we can put in is a fairly regular, we've been getting this year, rises from domestic energy suppliers. I think this month's one was E.ON. Next month we'll see EDF, the month after British Gas. So these players are all in there, and we find ourselves again looking at inflation rate 2.7%. Even worse for those who still like the number we've used for the last 60 years, the retail price index, that's gone up to 3.5%. So on that, real wages are falling and haven't really actually recovered at all. So there's a fair bit to think about as we play through the numbers. You may be wondering, if you just take a cursory look at them, why I haven't mentioned what officially we're now told is the headline number, which is called CPIH. The reason for that is the H, which stands for housing costs. In itself, that's perfectly reasonable. Should they be in there? Yes, without a doubt. Owner-occupied housing, in case you didn't know, is missed out from CPI. The rhetoric and propaganda from our statisticians is that CPIH is our most comprehensive inflation measure now because it includes owner-occupied housing costs. That's simultaneously true and untrue. Yes, a measure goes in, but it's completely rubbish. They assume that people who own their own house pay themselves rent, which they don't. Even worse than that, the UK has problems with measuring rents, and we find that the number of 0.9% is, from those that look at it, certainly too low. The catch here is that they've got the wrong mix between new and old rents. But bringing that back in, and now into the headline number, well, 0.9%, what does it do? It brings it down. It's quite heavy weighting in the index, 17% for owner-occupied housing. So we find, hey presto, the inflation number's now smaller, which is part of the game again, trying to tell people they're better off when this isn't necessarily true. And let's be careful about this. I've got no problem at all with putting rents in for people that do rent. It's the fantasising that people that own their own house pay themselves rent. That's the problem here. This gets worse if we look at the economics, because you'll find a lot of places now using that number to deflate things. But how can you deflate things or have a cost of living with something that's never actually paid? It might seem an arcane point, but this is very important, because there's been a long-running theme going along of getting the inflation numbers lower. Why? Well, for example, they go in GDP. Round about a quarter of the inflation measure in GDP is consumer inflation. So the impact on that, roughly, has raised GDP by about 0.5% a year, taking RPI out, CPI in. So these things do have an impact as you move around. And to my mind, it's one of the factors whereby people think things aren't getting better, but the numbers tell them that they are. It's very, very important, I think, that the numbers should be done honestly. Now, I think that's different from 100% accurate, because there's always going to be differences in people's circumstances, always going to be something that's measured wrong. But you can at least honestly try and do it in the first place. In the UK, we find that this is an ongoing issue, because psychologically, we seem to be prone to it. We do get inflation. Had phases also of the pound being weak, that's related to it. And these two things economically haven't done us any good over time. Thank you.